Welcome to Taking Stock for the week ending 5th of April 2024, where this week myself, Tim Lincoln, and our head of Stock Doctor Research stream to you all things share market. I hope you're all well, and wherever you are around the country, your families and the like are all doing well also. How are you, Kien? Is April off to a good start for you and the research team?
Yeah, not too bad, Tim. I mean, there's so much going on, and I've been, preparing for the masterclass, which is going to be very exciting. It's coming up in the next 2 weeks, we'll be very excited to present and educate our members, and with you and Maddie Swartz and Dan Ortiz and some of the other guys.
Yeah, I can't wait also, Kien. And we got, as you said, Sydney in under 2 weeks' time, and which is really exciting. We've got a lot of content to share. It's similar to what we did in 2019, but obviously updated for the current environment and all the enhancements we've made to Stock Doctor. Still a few spots left too, ladies and gentlemen. So if you're interested in attending Sydney or Melbourne, then just click on one of the links or in the Daily Digest email, and your spot will be secured. All right, let's get into it, Kien. Lots to get through today. But before we get started, just a reminder that all the information we share is of a general nature and therefore should not be construed as personal advice. And all of the data and information that we also share, all historical in nature, and therefore should not be relied upon as a guide for future performance. Okay, Kien, here we go. And the markets continue to trade near record levels at the end of the quarter, with the daily fluctuations driven mainly by economic data influencing interest rate expectations. However, despite news of a stronger jobs market or manufacturing activity, we need to be really cautious still not to get caught up in the market noise. We've really got to still continue to block that out if we've got that long-only strategy. And all of the noise can obviously lead to irrational investment decisions, so be really careful. Instead, it is important to focus on your longer-term investment objectives and continue to apply risk management strategies to help you manage those particular risks. And strategically, Kien, we continue to believe at Lincoln Indicators, and myself personally, we continue to believe that share prices are elevated and really disconnected from company fundamentals, which overall remain pretty weak. In the face of higher interest rates and a slower economic growth. The market is currently driven by speculation, the fear of missing out or FOMO, and artificial intelligence boom, which just continues to really skyrocket things, especially in the US. Not to mention the influence of exchange traded funds or ETFs and index funds have contributed to the significant flow of money into most stocks, irrespective of their fundamental quality. And that's a big problem I've got with passive investing or ETFs, is that money finds its way into not only the really good companies and the higher weighted companies in a higher weighted capacity, but also the garbage stocks. And that doesn't make any sense to me at all. So question the sustainability. This is why we have continued to hold on to our hedge position in all of our Lincoln managed funds to protect our clients' capital, as we see it's a fiduciary responsibility in the event of a market correction, which has historically occurred when this dislocation between earnings or company fundamentals and share prices play out.
Yeah, that's quite a huge risk there, Tim. And speaking about the risks, over the week, I've noticed also the simultaneous rally in both gold and oil, and that appears to be signaling heightened geopolitical risks, which could lead to higher volatility for the markets. Now, the rising gold suggests investors are moving towards safe haven assets, while oil prices have increased on the back of investor concerns about supply shocks, particularly with escalating tensions in the Middle East. Now, with elevated oil prices, that can keep inflation sticky and could force central banks to keep interest rates higher for longer, presenting a significant risk for corporate earnings, valuations, and also companies with high debt levels, Tim.
Yeah, it's really hard to block all of that out. I know we say you've got to block out the noise, but there's some elements there that are really, really hard to block out, especially the disconnect, but also when combined with all the other things you've just been through, Kien, it really does create a very, very interesting environment right now for equity investors. That's why it's so important, Kien, isn't it? to continue to focus on high quality business, which is paramount at this stage in the market cycle. Positively, we have continued to see a recovery in the performance of our star stocks, which is great, both star income and star growth, with our star growth stocks up some 10.6% over the quarter, and really strong returns over the last 12 months, outperforming the market quite significantly, which is really positive, Kien.
Yeah, the performance of our star growth stocks can also be attributed to the recovery in the growth style of investing, Tim, which has gained some favor on the back of interest rate cut expectations for this year. And the chart on screen compares the performance of the different quant styles of investing over the last quarter, and it shows that growth has outperformed value and also income investing. However, the strongest performers, Tim, have come from momentum-based strategies. And as you mentioned earlier, that's driven by the increasing fund inflows from those exchange-traded funds, and also fear of missing out among retail investors specifically.
Yeah, really dangerous when it's just a momentum-driven market, Kien. The chart also shows, although dividend yield strategies have lagged the market over the quarter, our income investors have been rewarded with star income stocks also performing well, as I mentioned before, returning some 6% compared to the ASX 200 benchmark of 5.3. So good outperformance there. This distinction here is that our star income stocks have benefited from our stringent stock selection strategies towards high quality businesses with sustainable dividends rather than just investing in the yield at all costs. And now turning our attention, Kien, to some star stock highlights. Let's take a look at Codan Limited. Been in and out as a star stock for a little while, but it's been brought back into the star stock universe following its first half 2024 result. According to Golden Rule 3, Kien, the company's outlook appears to be quite robust in the near term. What is actually driving these assumptions, Kien? Because to bring a stock like Codan back in, we've got to have that conviction ourselves that it is sustainable over the medium to long term.
Yeah, Tim, I mean, when you look at Codan, the premise of its projected earnings growth over financial year 24 and financial year 25 is due to this anticipated recovery of their metals detection earnings. Remember, they've got that proportion of earnings. And previously, it was impaired by geopolitical conflicts across the Northwest African region, particularly since the onset of the 2021 Sudan military coup. Now, the situation appears to have stabilized as consensus and management are now forecasting a plateau in their regional earnings. However, the other thing to note is, secondly, management's focus has been around the growth of its communications division, which involves the manufacturing and sale of radio equipment. Since 2021, this division has grown from 30% to 60% of total group sales, and that's driven by several cash-funded acquisitions. It's also highlighted a level of success in management's goal to diversify the group's earnings away from the inherently more volatile metal detections earnings, Tim.
Yeah, a lot going on there. And although it sounds promising, Kien, our analyst Ryan Lim has outlined several key active risks that really need to be taken on board and considered for this stock, as always. I encourage members to jump in to Stock Doctor and have a good look through and read the analyst commentary in their time to really understand those active risks to make sure you're comfortable with this particular stock and potential exposure. Another stock to make its way back into coverage, Kien, which is good to see, Treasury Wines. Our analyst Jason Yin saw the removal of Chinese tariffs on the Australian wine market as a catalyst for near-term earnings growth. And it seems like this thesis was justified when China's Ministry of Commerce confirmed the removal of tariffs this week. So all positive for Treasury Wines, considering the Chinese market is so large. They certainly do love our Grange, Kien.
That's right, Tim. And it was quite a timely reinitiation On Jason's part, Treasury Wines now as a borderline style growth stock. The Chinese market was a material contributor to Treasury Wines' performance, accounting for around 25% of the Penfolds global volumes, or approximately 30% of its group earnings in financial year 20. So now that the gates into China have reopened, Jason estimates that there's going to be an additional $60 million to financial year 25 earnings, or roughly around 10% upgrade over the current consensus forecast.
The company also, Kien, has increased its exposure to the US market via a recent acquisition of a US vineyard called Dow. Performance in the US has been a bit of a mixed bag, though, with slowing consumption of lower price wines, which has resulted in the destocking of inventory with retailers and thus weighing on TWE sales and profits. So has the market in the US changed, Kien, of late, or are things still quite stable?
Yeah, Tim, the demand for those lower price wines has been a key risk, and we remain cautious on the Americas market given the challenges faced by the 19 Crimes wine brand, which showed faltering sales in the December quarter as wines in that $11 to $15 per bottle category didn't really grow as fast as expected. So while the reopening of China provides a favorable tailwind, slowing performance in the US could temper near-term sales and earnings. But it seems like this has been factored into the share price, Tim. Now, onto the corporate calendar for the week ahead. There will be no results for our star stocks, although Endeavour Group, Suncorp, Woolworths, and also Supercheap Auto, they are expected to pay their dividends next week.
And now to Under the Microscope, Kien. And this week we've got a fantastic case study. Aurora. Aurora's a ex-star stock from a few years back, but not currently. And it's been a big week for them based on a couple of events, but also their last report was a bit dodgy, and we take a look at that. But Aurora is an Australian-based company specialising in the packaging of food, beverage, and retail products. The company appears to exhibit robust earnings characteristics, Kien, with return on equity of 14% in its first half 2024 result, all visible under Golden Rule 2. However, and it's a big however, Kien, because its financial health has dipped from satisfactory to early warning in the past reporting season. So, Kien, are you able to peel back the layers and help our members understand the contrast between its earnings profile and its faltering financial health?
Sure, Tim. At face value, it is a profitable business. However, if we were to compare this to historical trends, we can see that Aurora's return on equity has declined from a high of 26% in financial year 23, and the drop in return on equity over that first half 24 was driven by the acquisition of French bottle manufacturer Saverglass in September 2023. The acquisition has diluted Aurora's equity base and also increased its debt levels, prompting a decline in that TLTAI ratio and its net debt to equity levels as well. That's risen as well.
Yeah, we don't like it when we see companies' financial health deteriorate, especially that gearing ratio TLTAI, Kien, which is based on an increase of debt and in this case an acquisition. But Aurora is a large cap business, so even large caps aren't safe to deteriorating financial health. And I also know, Kien, that recently they provided an update to the market, which was also concerning. Can you provide some light to our members on what led to that downgrade in their earnings?
Yeah, management flagged lower earnings from that French Saverglass division. In addition, it's been quite a soft growth environment in its core packaging business, Tim, and this has prompted negative consensus earnings revisions for financial year 24 forecast, and that's under Golden Rule 3.
Okay, so deteriorating financial health and now some revisions to forecasts coming through has led to that share price being hit hard. of late. The stock is trading at now around 15% below its consensus target also, Kien. So it's a silly question because I think everyone knows the answer, but we'll ask it anyway. Does this represent an opportunity for members who are taking a long-term view of the company?
Yeah, we just got to be careful here, don't we, Tim? Given the recent decline in its financial health rating, and that's due to that increased debt level. But it might be prudent to wait for investors to wait until the balance sheet improves here. That would help the business weather the storm if tough market conditions continue.
And a question of the week, Ian, and it's on the back of the steep valuation discount with regards to financially unhealthy business Aurora that we just covered off on. A useful question for investors this week is, what should investors be careful with when relying on Golden Rule 5 valuation?
Yeah, when you're looking at valuation, Tim, the fair value of that stock on Stock Doctor is the median of the total analyst estimates that cover that stock. And these estimates, if you think about it, are subjective, and they're also based on future assumptions, including cash flows and interest rate assumptions, which can change very quickly.
And when a non-star stock is trading at a significant discount to valuation, it often implies that there are heightened risks attached, which could lead to further earnings downgrades and share price declines down the track. This is also true for income stocks that display a dividend yield that looks too good to be true. This concept is referred to as a value or yield trap, and often occurs with companies in poor financial health that have no profits or strong negative earnings revisions.
Yeah, and under Golden Rule 4, Tim, you'll find that consensus share price targets, it tends to follow share price movements rather than predict where prices are likely to go. And you also find that value traps may occur in tandem with rising short interest or director selling as well. However, for star stocks, Tim, a large discount to consensus price target could imply opportunity. However, you will need to be aware of those active risks and fully assess metrics like earnings revisions or the rise in short interest. Stocks that have been sold down significantly but have stable earnings trends could help you have more conviction in the opportunity.
Yeah, good advice, Kien. And similarly, great quality companies can trade at a premium to valuation for an extended amount of time. This could also have a high, these stocks, could also have a high PE multiple due to their strong market position, quality metrics, and growth prospects. You know, CSL and Cochlear generally have always traded at premiums to their valuation. So sometimes we've got to be prepared to pay a premium for real quality. So yeah, it's even though some of those businesses seem expensive, you can't, they're expensive for a reason. So rather than invest using valuation blindly, it's best to use it in a combination with other golden rules and understand why a stock is trading at a discount or a premium. Benjamin Graham, mentor to Warren Buffett, and obviously the author of The Intelligent Investor, observed that the greatest losses result not from buying quality at a high price, but from buying low quality stocks cheaply. So yeah, really, really sound guides there from one of the great investors and mentors of all time. But that's the end of another recording, Kien. Thank you very much for your contribution, and yeah, really good tidy script today, mate, with a lot going on in the market.
Yeah, Tim, there's always something going on. And again, as I said, you know, we look forward to preparing a really educational event for our masterclass within 2 weeks.
Yeah, can't wait to be there with you and the team and see a lot of our members there also. Really exciting, Kien. All right, as I said, there's a lot going on in the market. Try to block out as much as the noise as possible, but obviously apply your strategy relative to your objectives in the current market, because we've got to have that long-term mindset always, but there are ways to mitigate risk and tactical ways to do so. And we're often talking about how to do that in various forums, and we'll certainly be focusing on those at the masterclass in a couple of weeks. But wonderful sitting down with you, Kien. To all of our members, stay safe, stay well, and we'll see you all again really soon. And also, for those that are tuning into Lincoln Live on Monday morning, we'll see you then. Take care. Have a happy, healthy, and prosperous week.